If you like your standards high and your growth even faster, pull up a chair because this is Dash. My name is Zach. I'm one of the hosts here on the DASHcast podcast, and I want to introduce you to Ned Liggon from Argos Home Loans today. So thanks for coming today.
Absolutely. Yeah, thanks for having me.
Awesome. So how long have you been in the industry?
I've been in the mortgage industry for about 13 years directly. Okay. Before that, I was in retail banking for maybe 5 or 6 years.
Okay.
Yeah.
Nice. What made you want to do loans and mortgages in the first place?
It was just a childhood dream of mine.
Okay, nice.
No, I just kind of fell into a banking job when I got out of college. Found my way into the mortgage industry due to the flexibility, and I like the commission-based compensation aspect of it. And here we are.
Nice.
Yeah.
Excellent. So 13 years in the industry. So I'm sure you've seen a lot of deals take place and work through a lot of deals and whatnot, right?
I've seen quite a few, yeah.
Yeah. I guess, so you help our office get a lot of funded loans and pre-approvals and things like that. The Raleigh office, Charlotte office, Greensboro, Fayetteville, Asheville, all over the place.
Everywhere.
All over North Carolina right now. And maybe South Carolina at some point too, from what I hear.
Mm-hmm.
Walk me through the last deal that you did that just fell apart.
Well, I haven't had any fall apart.
Okay.
Well, with you guys, let's see. The last one I had that fell apart. Jeez. I can't really speak to that. I've had one, but I can't think of it. I mean, they fall apart for different reasons. The appraisal coming in low.
Yep. Mm-hmm.
And clients not having enough cash to bridge the gap, not being able to negotiate sales price with the seller.
Mm-hmm.
There have been unforeseen tax liens pop up, things like that have thrown deals off. All kind of things that pop up during the underwriting process that are not apparent during the pre-qualification process,
Mm-hmm.
That maybe are withheld by the borrower, or maybe they forgot about it, or
Sure.
Things like that. So I mean, it's usually things that affect the ratios, like a payment that pops up somewhere that we didn't know about, or like I said, a large debt or credit issue.
Okay,
Yeah.
Gotcha. Do you think that a lot of times that is solved based off of just going really deep early on in the process to, I've heard about getting a pre-qual, pre-approval, what's the other one? Underwritten pre-approval, things like that. Like what have you seen the most success in when you talk to clients?
I mean, for the most part, when we do a pre-qualification, we'll review income and asset documentation there. Have an in-depth conversation with the borrower, but during the actual loan process, there are Cavers reports ordered, which are like kind of background check type things that check like multiple databases for any real estate or financial information that might not be readily available and stuff like that. But during the pre-qualification, the docs are reviewed. A pre-approval is technically reviewed by an underwriter first, and if you have a more complex file, you'd want to go that route. But for the most part, a loan officer pre-qualification or pre-approval there is really all you need.
Yeah, and I mean, in our market, I know it's very difficult. Years ago, you'd submit an offer and you might not necessarily need a pre-approval, but on the listing side now, I kind of expect clients and buyers to submit at least proof of funds or pre-approval just to give my seller peace of mind, right?
For sure.
What are some ways that you help clients to win in that area once the offer is submitted?
Yeah, a lot of times I'll, upon the buyer's agent's request, we'll reach out to the listing agent and just speak to the strength of the buyer. Talk about the steps I've taken in pre-qualifying them, and the docs I've reviewed, and how in depth the process on my end was, because it's not the case with all lenders. Some folks will just run it through, take your word for it, and move on.
Right. It's good to count your ducks in a row, right? Or
right.
have your ducks in a row.
Yeah, for sure. Because the last thing I want to do is pre-qualify somebody, have them go through the process, and then the loan fall through, because that's it's really stressful for me, but B, the borrower has skin in the game with due diligence and earnest money, and it's just a waste of time for everybody. But
Right.
I mean, mainly selfishly, it's the stress on my end that that keeps me from slinging out unverified pre-qual letters here and there.
Yeah, so I guess it seems that if a good agent will ideally work in combination with a lender to make sure their client is well prepared before they submit an offer on the biggest purchase that they'll probably make ever, right?
Yeah.
I mean, most people aren't going out and buying Lamborghinis or, multi-million-dollar houses all the time, right? So most folks we work with, $300,000 to $500,000 house, right? And that's a ton of money. So making sure that we make those right steps and make that introduction and explain the whole process up front helps to avoid some of those pitfalls.
Absolutely, 100%. Yeah.
Awesome. If you had to blame one thing for 80% of failed deals, what would that be?
I'd say failure to disclose information by a borrower.
Okay.
I mean, a lot of times they will withhold material facts, because they want to be qualified, but they don't realize that things are going to shake out in the process anyway. So I think that's probably the biggest, I would say the biggest catalyst there.
Yeah, I mean, I get it, right? People don't like people kind of snooping around in their business, right?
Right.
We live in America, right? So, but I totally get that. Where they might say, I don't have I don't pay alimony, for instance, or if I have large credit card debt. I mean, usually that is picked up, but if I have other, you mentioned tax liens and things like that. Those are
like child support, alimony, tax liens. I mean, there I guess a handful of different things that can pop up that are not disclosed up front. Yeah, sometimes.
So it sounds like in order to help our clients be the most successful, it's to partner with the right people, right? At the end of the day,
Correct.
The right lender, have the right person to go out there and inspect the property, right? Agent to help show the property, closing attorney to help with all that stuff. It seems like super important when you're making a big decision like this to do that, right?
I think it's highly important. Yeah. And I mean, unfortunately, a lot of buyers, and I mean, I guess a lot of people in general are so heavily focused on the rate and the cost from a lending perspective. And so there's laser focused on like interest rate, and will just like shop you over a couple $100 here and there.
Yeah.
When really in the long run, I mean, it's a smoother process is white glove service is really a lot more beneficial and helpful than like zeroing in on like the lowest rate or the lowest fees or whatever. Just because, I mean, we're all pretty much pricing from the same sheets. I mean, we can, depending on the day, depending on the appetite, we can probably fluctuate here and there, but for the most part, it's going to be pretty close to the same. And I think, the focusing on the service aspect of it
Absolutely.
versus the rate, I think is very important.
And you've probably heard this, being in the industry for 13 years, but you date the rate, but you marry the payment, right? So if that payment makes you feel safe and comfortable, and you're able to make it every month, then that's what matters most at the end of the day.
Right.
And so and also how long we're going to stay at this property. On average, I feel like clients stay at homes anywhere from 3 to 7 years, and then they move on. So if I get a 30-year mortgage, this is what the monthly payment is. That makes sense for me. I'm going to move on in 5 years or refinance, things like that.
Correct.
Right?
Yeah, that's right.
Awesome. Well, what are the rates right now? Are they like pretty level? Are they pretty high? Like what are they historically based off of like where we're at last year at this time?
They're a little lower than we were last year at this time. I mean, we're floating around the low 6% range on a 30-year fixed good credit with no points. I mean, seen it hit the fives a little bit here and there, but they're fluctuating still, and on a downward trend on the large scale. So, I mean, I think we'll continue to see them to go down, but I mean, it's not there's not going to be a quick, drastic decline anytime soon. But yeah, right now especially, it's like I'm telling people, you should probably be prepared to look at refinancing sometime in the next couple of years. I would think. I mean, there's no crystal ball, and you don't really know. But I mean, everything points to the rates continuing to decline, and we're not going to get back down to the 2-3% range anytime real soon. If we do, there's a problem. But
do you think we'll ever get that low again?
I wouldn't think so. I mean, not naturally. I mean, if it's done artificially through bond buying and those type things, then possibly. But I mean, you have to look at what happens when the rates get that low. I mean, it causes a huge surge, just like it did in like 20 to 22ish, and then after that, there's a huge lull. So I mean, because we saw when rates peaked, and I think it was October 23. They hit like 8%, and I mean the market just kind of died for a little while. I mean, it was extremely slow. So I mean, you'd really prefer a balanced market. I mean, in general, it helps with the supply and demand, the prices. I mean, all that stuff. So.
And I think the rates today are kind of what they were like maybe about a year or two before the pandemic happened.
That's right. Yeah. Which I mean, historically, I mean, if you look at very large scale, I mean, they're pretty low on the grand scheme of things. Right. It's just like people, most people that own houses right now have a 2 or 3% rate because they refinanced or bought, back in the early 2020s, and so like 6% seems astronomical. But I mean, it's really for 30-year money. I mean, that's a pretty good.
Yeah, I've got a client that has a 1.9 on his, and he was like, "I'm thinking about selling." I'm like, "You will never sell this property. I'm gonna make sure you never do, because that's, I mean, why would you do that?
Well, I mean, because you want to trade up.
Yeah. I mean, he's used as a rental property, but like, let's borrow against it, and then
there you go.
Maybe do something like that. Yeah, I mean that time was pretty crazy because there was barely any inventory at one point. I think there was like 3 days of inventory. So if you got a house, you got a deal, even if you paid $150K over for it.
Right, for sure.
I remember talking to my parents and like some other folks around the time when they got their house in 91, 92, and I mean the rates were like 14.5%. But again, prices were a lot lower then.
Right.
So that's kind of where we see that big difference now. Right?
For sure. Yeah.
So let me ask you this: what's the conversation that you feel like most agents are avoiding with their buyers, and it's actually like costing a deal to get to the finish line?
Man, you guys should have fed me these questions ahead of time so I could have some time to think about it. Most agents avoiding with it. I'd say, honestly, I don't know. I can't think of that. But like one thing I will say, like coaching your buyers to shop rate is a bad idea. That's one thing that I see. Like coaching your buyers to shop rate, it only convolutes their. I mean, they're talking to 3 to 5 different lenders and getting different structures from every one. I mean, everybody gets confused and they end up going with some internet lender that's probably going to provide a poor service.
Gotcha. Okay.
Yeah. As far as what they don't talk about, I mean, I think mainly coaching the client to be open and honest with the lender. Make sure you kind of open the books and let them know everything, because I mean, I'm here to make sure that they get qualified, right? So, I mean, I'm going to work around any obstacles that we have, but if I can do it on the front end versus doing it when we're in a tight timeline, under contract, then obviously that's going to be more beneficial. We're here to help them buy homes, and, we want to close loans. So we're not going to drop the hammer on them if they've got, some sort of blip on the history, but it's something that I need to work around because it's going to come up during the process regardless.
Yeah, and I run a team of 40 agents, and one thing that we always coach them is just to say, hey, if it's a good idea to at least talk to multiple lenders, at least then that way your client can see if the grass is greener somewhere else. But like you said, it depends on who you talk to, right? If you're talking to some, we always recommend, hey, if you bank with Wells Fargo, Bank of America, talk to them, right? But we've got some great lenders that we work with that provide that white glove service that's going to give you great service from start to finish and even after the transaction. Why not at least talk to them too, I
mean, I would say you as a real estate professional, they're looking to you for advice, right? So, I mean, you're the professional in that arena, and you have lenders that you know and trust that you've worked with that provide good service that, qualify on a deep level. I think you are doing them a disservice by letting them just go out there and choose a lender. I mean, I feel like directing them to a lender that is going to do the best job they can for the client is part of your responsibility as a real estate professional.
Yeah, and I guess for me, the reason I do that is they're going to see when they talk to their bank that their bank is not as good as my lender, right? I guess that's kind of my mindset of doing it, right?
Okay.
It's more of go out and see how bad it is, and then come back and you'll see how great this is, right?
Sure.
That's kind of my mindset with it, but also just to, I want all the clients to get the best deal possible when they sell a house, and talking to them about what they want to do with the property. If they're going to own it for, 5 to 10 years, going with Ned at Argos would be a great option, right? He's going to give you a great service. He's going to do all these different things for you. When I was buying a house, we actually used Ally to get our pre-approval, which Ally, they don't even have physical addresses anywhere. Like there's no building. It's just an online lender, like you said, an internet one. But then we ended up swapping, we had got another pre-approval with someone else that gave us a better deal, a better situation. We went with them. And then of course we've been with them for quite some time. They sold it off a few times, but if we didn't get pre-approved initially with Ally, then, that wouldn't have started the conversation in the first place. So for me, I think it was good that we can educate our clients to talk to the right people and partner with the right people to be able to move forward.
Yeah,
right?
for sure.
So, what does an agent do in the first 24 hours of a transaction that tells you everything about how it's going to go?
I mean, I like when agents send out detailed emails, and a lot. I think that's probably a standard for you guys specifically.
Yeah.
But I like the detailed emails to the lender, the closing attorney, maybe insurance if that's been chosen, but it just shows all the details that you need, just kind of broken out into bullet points. I like that. I mean, as far as anything else goes, I can't really, but I mean that's very helpful, and it just helps frame the process for everybody.
Yeah, I mean, you want our clients to be set up for success, and the same thing for us on your end too, right? So,
absolutely.
I always say that we got a great team to work with, and if you work with me, you're going to get great lenders, great inspectors, great closing attorneys, great everything, right?
Yep.
So, let's see here. Give me a real example if you can when there's a tight agent-lender relationship and how that saved a deal that could have died.
Well, I mean, I think having just constant communication, open and honest communication between the lender and the realtor. I mean, overall, that just helps. And when everybody feels comfortable with each other, when you feel like you can shoot me a text, at 8 p.m. and ask me a question, or if your client, says I can't get in touch with my lender, if you can reach out to me and be like, what's going on? You know what I mean? Things like that. I think that just helps overall in the transaction. Just in general. I mean, just having that open working communication is key for sure.
Yeah, I think, communication is the bedrock of every relationship. I think personal, business, professional, everything, right? So I love that I can text you any time of the day and you'll respond and say, yeah, let's hop on a group text with the client. For that introduction or during the process, you give us a kind of like a checklist going through here's some updates where we're at in the process, and you give us a call and kind of talk to us about that. For me, that gives me reassurance that things are going well, because I've had situations a couple of years ago. I was representing a seller, and the buyer had this internet lender, and the day of closing, I hadn't heard anything for a bit. Called the agent. I was like, hey, what's going on? They're like, yeah, we can't close. And I was like, what happened? They were never able to get fully conditionally approved. And I was like, what in the world?
Yeah.
And so that taught me I need to, even on the listing side, to be proactively making sure things are going to keep moving on for my sellers, right?
Yeah,
so,
for sure.
So Ned, at Argos, what are some of the loan types that you guys offer? What are some of the programs, packages, all the stuff?
Yeah. Well, I mean, obviously we offer conventional FHA, still waiting on VA approval, which should come any day now. USDA, so all the standard, conventional Govy loans. We do jumbo loans, which is any loan above, I believe it's 832, 750, I think is the number. And have multiple investors there that we can shop for you. And then we do some different deals for investors, like DSCR, debt service coverage ratio loans, for business owners like bank statement loans for people who aren't, can't qualify from tax return income alone. So pretty much anything with a structure on it. We do not do land and lot loans.
Okay.
But pretty much anything that has a residential structure on it, we can finance.
Mm-hmm. But of course, if I have clients that need help with land, I could probably refer them to you, and you'd have a referral.
For sure, yeah. I've got some contacts.
Gotcha. Okay. Well, talk a little bit about like the FHA. I mean, I feel like I work with a lot of buyers that utilize that loan package often because it's very appealing, right? So, kind of talk a little bit about the FHA stuff.
Yeah, FHA is good for folks with lower credit scores, low down payment abilities, and things like that. The rates and kind of the mortgage insurance there it's fixed regardless of where your credit is, or the mortgage insurance that is, and then the rates are more forgiving from a loan level pricing adjustment standpoint for lower credit scores. So FHA, it's good. It's got it does have a mortgage insurance premium, so 1.75% of the loan amount is going to be tacked onto the loan balance. But again, it's just kind of hedging risk there. But yeah, overall, it's a great loan program for, like I said, just maybe first-time home buyers or folks who are working on building credit up. There's a lot of misconception out there about like FHA appraisals being so much stricter than conventional appraisals, which used to be the case. But I mean, the conventional appraisals are also pretty, they're more heavily scrutinized now. There have been more regulations kind of down on that. So they're actually not that much different. I mean, the FHA appraisals, there are a few quirks there. But overall, I mean, if a property's in decent condition, you're not going to have an appraisal issue.
I think, we coach our agents if it's safe and it's working, usually you're okay. Right.
That's right.
I think sometimes we've had issues with like, wood rot, peeling paint, things like that, right?
For sure.
But I've
that's
seen,
going to be across the board, though.
Exactly.
Yeah.
Right. I had one a few years ago where that was a huge issue on one. We backed out, moved on another property. The other property had it, and then it didn't get flagged, and so we were like, okay. So
it depends. It also depends on the appraiser and what he's going to pay attention to. So I mean that's just like anything else.
Exactly.
Depends on who you're working with.
Mm-hmm. Do you guys offer any like incentives for first time home buyers, things like that?
We do. We've got a good down payment assistance program, the Home Zero program, and it's basically an FHA loan, so 96.5% primary loan with either 3.5% or 5% down payment assistance.
Okay.
So it'll finance either 100 or 101.5% of the purchase price. The rates look different, obviously, between those two. So depending on which one you choose, the rates on the 3.5% down payment assistance are going to be a little better than the 5%. But yeah, it's a great program. So I mean, essentially, if you pair those programs with some seller paid closing costs, then the buyer's contribution at closing can be very minimal to nothing.
Excellent.
Yeah,
that's great. Tell me a little bit more about. We work with a lot of investors, and I'm sure some of the agents watching this do too. Talk a little bit more about like the DSCR and bank statement stuff.
Yeah, the DSCR deal. So basically, we'll take an investment property. The down payment requirements depend on the ratio, which the DSCR, debt service coverage ratio, is the gross income that you'll get from the property, either by a lease or a 1007, which is an appraiser's rental estimate, based on comps. Generally needs to be about one and one. So it needs to cover the payment plus the PITI, so
right.
interest tax, insurance taxes, interest and principal. So so essentially, depending on that ratio, the down payment can differ, but usually it's about a 20 to 30% down payment, and it's it only takes that ratio into consideration. We're not looking at the borrower's income or additional properties or any of that. It's just solely focused on that transaction. So for an investor who owns multiple properties or somebody who is a business owner that is has more difficult kind of income documentation to to decipher, then it's easier for the investor to go that route than to have to supply, all the
absolutely
the heavy documentation requirements.
Do you see those often?
Fairly often. I mean,
Okay.
not a ton, but yeah, I mean, we've got some investors around here that utilize them here and there.
Nice. Yeah, I mean, I think I heard about those like maybe 3 years ago, and I was like, man, this is a cool kind of loan package.
Very cool, yeah.
So,
as the real estate prices and the rates increase, sometimes it can be tough to get the ratios to work. But,
exactly.
But yeah, it's definitely a good product.
I guess as an agent, if we had a client that was interested in that, obviously talk to you first, but getting some documentation from the listing agent, like a rent roll, things like that would be helpful to
Correct.
kind of move forward with you.
Absolutely. Yep.
And bank statement loans, talk a little bit about that.
Yes, I mean, that basically, for a business owner who's been in business for at least 2 years, will take 12 months worth of bank statements and analyze the bank statements that they run their business through. It can be personal or business, but analyze the income and expenses that are coming in and out of there and use that to decipher income rather than what they reported on their tax returns.
Gotcha. So it's more of like for 1099s and things like that typically might utilize something like that.
Correct. Yeah. Yeah. I mean, anybody who's a business owner.
Well, let me ask you a question before we kind of wrap up here. I've heard a lot of differences between utilizing like an investment loan versus like a DSCR. Like, is there any real difference in your mind other than just like how much you bring to the table?
Well, it depends on a lot of different factors. But I mean, if you're going to do just a conventional investment property loan, then it's going to be a full underwrite. So we're going to look at your total picture, your income, property zone, total liabilities, and all that stuff. Whereas if we're looking at a DSCR property, we're just looking basically. I mean, the borrower has to be qualified and they have to be credit qualified and those type things. But like, we're just basically looking at that ratio for the most part. So we're not digging into really anything else. So I mean, it depends on the specific situation.
Gotcha.
Yeah. Down payment requirements for both are pretty similar.
Yeah, 20 to 30% usually.
Yeah.
Well, I guess what's a way that folks can reach out to you if agents need help getting some loans? I know you service. I think you said your license was in North Carolina, South Carolina, Tennessee, Virginia, and Florida.
Correct.
So that's a lot of the East Coast. So you can help a lot of folks in those areas, especially like if agents have referrals in those areas, things like that. So how can people get in touch with you?
Yeah. I'll throw my contact information up there so I don't have to say it out loud. Call, text, or email. Yeah.
Excellent. And we'll put it in the description and the community notes, all those different things. But Ned, thanks so much for coming on the DASHcast podcast. And we're glad to have you. And maybe we'll come back again and talk about other things.
Sounds fun.
Excellent. This is the DASHcast podcast. Make sure you comment, like, share, and subscribe. And let us know other content that you want to take a look at. And we will prep that for you. See you next time.